All right, Holly, you good to go.
Thank you very much. Good morning, everybody. I'd like to call the meeting to order. The time is now 9:04. Stephanie, would you please take attendance?
Yes, thank you. Good morning, everyone. Adrian Cochran has not joined us yet. Andrea Comer has not joined us yet. Ellen McKitterick,
Present.
Scott,
I am here.
Mike Saltis will not be joining us today, and Holly Williams.
Here.
All right, we do not have a quorum.
Okay, thank you. And I'd like to thank any members of the public who are tuning in this morning. Because we don't have a quorum, we will table agenda item number 2, which is review and approval of the September 27th, 2024 meeting minutes. And we will proceed to the presentation of the audited financial statements for the fiscal year ending June 30th, 2024. And Widdles Lee will provide us with that presentation.
Who is going to be? Okay, great. We've got the screen sharing set up.
All right, thanks. Good morning. Can everybody hear me okay? I just want to make sure my mic works before I get too far into this.
I can hear you.
Yes, we can.
Great, thank you. So good morning, everybody. Thanks for having us. My name is Tom Goldfuss. I'm partner of Whittlesey. Joining today is Katrina Olson, Senior Manager, and Rob Warren, Senior Accountant. We're going to go over the results of our audit. I assume everyone had a chance to review the final audit that was issued last week. And any questions, either interrupt us during the presentation, or we certainly have time at the end for those questions. I'll start by introducing going over the overview of the audit results. Katrina will go over some required communications. We'll talk about some of the financial statement items that are pertinent to this, and then some technical updates that will come that are actually effective for July 1st for you. So if you go to the next page, Katrina. Right, Katrina, you're the one sharing? Just want to make sure I get that right. You have access?
Yes, that's right.
Okay. So one other person I want to just give a quick mention about is Chris Wisniewski. He's our IT Security Assurance Manager. As part of our audit, what we do is we use some internal specialists at our firm that review primarily the IT controls over financial reporting, so to assist us in our audit. They also add an additional layer of some additional testing and review that they do of the IT systems that we include with the service we provide. By all accounts, everything looked very good on their end. So that doesn't get mentioned in our audit, but I just wanted to bring it to this committee's attention just to let them know that that was done, and that clean bill of health was noted from what they were looking at. On the next slide, we'll go over the audit results at a very high level. The main thing is that the financial statements have an unmodified audit opinion, and that's the highest level of assurance that you're looking for from an audit. Our agenda is to make sure that the financial statements are free from material misstatement, whether due to fraud or error. We also do a report and audit in accordance with the government auditing standards, which is primarily due to you being a quasi-public entity. We do a lot of nonprofit work as well as a firm, so a lot of nonprofits also have this requirement and this procedure done. The purpose of that is to look at internal controls over financial reporting as well as compliance. There were no findings reported on that. That was also an unmodified report. So from the high level summary is that everything was good, and that there's no findings or areas to communicate to you. Let's see. This, of course, as you know, our first year auditing the authority. So part of that involved looking at the prior auditor work papers as we develop an understanding of your authority as well as the significant audit areas. Of course, no issues there. In working with Dave and Locke and Walter and Amy, there were no difficulties, and all information that we requested was promptly received. We had at least weekly check-in calls to especially being in the first year, to make sure everything was on track. And again, from my perspective, and I think Katrina and Rob would share this, for a first-year audit, things went very well. And again, I'll emphasize no misstatements were identified that required any type of correction. I think there may have been one there may have been one post-closing entry, but that's just due to when reports were received. Probably two entries, right? The benefit claim reserves, which of course you wait until more information is known, and then the pension adjustments with the state. But again, that was assumed. We knew about that ahead of time. I'm only reporting that for transparency purposes, not because there's any type of issue with that. The next slide, Katrina will go over some more detail about required communications that we are required to communicate to you. This also comes in form of a letter that's issued with the audited financial statements in accordance with our standards. But Katrina will give you an overview of what's documented there.
Well, good morning, everyone. Thank you, Tom. So as Tom mentioned, we did already issue our letter of required communications at the conclusion of the audit and provided that to you. And this slide summarizes the content of that letter. As we also did provide at the outset of the engagement in April, we provided an engagement letter that describes our responsibilities under professional standards. And then we're further discussing that today in this presentation. So during the audit, we reviewed the application of the authority's significant accounting policies and did note that they were consistently applied. There were no new policies adopted in 2024. There was a change in application of accounting for the subscription-based IT arrangements known as SPIDA, based on management's reevaluation of the authority's IT arrangement. So the net impact of the financial statements was immaterial. It resulted primarily in a reduction to the right of use asset and the related liability. So there was an immaterial impact to the net position. We also obtained management's representations prior to issuing the financial statements on October 18th. During the audit, we also evaluate significant estimates, including the methods, assumptions, and data used to develop them, and we found them to be reasonable. Some of the significant estimates of the authority includes the reserve for the benefit claims, also the allowance for uncollectible receivables, and the pension liabilities. As Tom already mentioned, there were no audit adjustments. There were no unadjusted differences, and we did not note any fraud or illegal acts during the audit process. We also did not report any material weaknesses or identify any material weaknesses, and we encountered no disagreements with management. So as Tom already alluded, the audit was completed smoothly. We exchanged information via a secure portal and had those weekly meetings that Tom mentioned via video conference between our audit team and the authorities team. And then lastly, we confirm we are independent with respect to the authority under all relevant standards. All right, our next slide talks about the required supplementary information accompanying the financial statements. So that's primarily management's discussion and analysis, and then also the supplemental pension and OPEB schedules that are a part of the financial statements being issued. So we did make inquiries of management about the methods of preparing this required supplementary information and compared the information to the financial statements and other knowledge we obtained during the audit. But because these are limited procedures, they don't provide sufficient evidence to express an opinion or provide any assurance. All right, this slide just covers our significant audit areas and transactions and our audit procedures on those areas. For cash and cash equivalents, we did confirm the accounts with the bank and tested reconciliations for accuracy. We confirmed the investments as well, held by the authority, and tested the fair value. Contributions receivable, the next two are really probably the most significant areas, contributions and of course benefits. So contributions receivable represent actual contributions received subsequent to June 30, and that relates to payroll periods ending prior to July 1st. So we did test those subsequent cash receipts as part of our audit process. We also reviewed method used to estimate the allowance for uncollectible accounts. We also, for the revenue, contributions revenue, we confirmed a sample of employer contributions. So we sent letters of confirmation directly to the employers confirming the amount remitted. And we performed detailed testing of internal controls over cash receipts, and no issues were noted as a result of those procedures. In regards to the benefit claims, we tested internal control, internal controls as well over a sample of claims. And we also reviewed the authority's monthly claims quality assurance audit process. Again, noted no issues. We also reviewed the assumptions used by the actuary in relation to the pension liability and the OPEB liability. We compared those to the actuarial reports. All right, with that, I'm going to turn this back to Tom to just go through a few numbers.
Yep. So as Katrina mentioned, the two significant areas are the contributions and the benefits. And then I'll say related to that, the receivable and the liability. So one to give you an overview of both on these next two slides. Contributions from participants are up about 5% year over year. That includes receivable growth of around 11% as well. Our understanding is that when reporting is done, it's primarily done on a cash basis, and then the accrual basis for the audit, of course, is required. So you may not have seen these final numbers with the receivables, but again, wanted to point that out to you. One thing on the receivables this year is that because of prior assessments were made beginning this year, and there's an offsetting allowance due to some of those amounts that may become uncollectible. So a little bit of the increase this year in the receivables because of that. However, year over year, this is pretty consistent with the increase in contribution revenue during the year. There's about 3 months of receivables or 3 months of revenue from participants in the receivables, which kind of makes sense because if you think of it on a quarterly basis, Katrina did mention that we spent a lot of time auditing the receivables, which again, the way it's handled is subsequent collections that come in after June 30th are recorded as receivables because, of course, they were due to you on June 30th. The allowance doesn't represent a significant amount, and again, it is different from the prior year, so we just wanted to mention that. On the benefits side, on the expense and the liability, claims expense is up to $385 million year over year. That's obviously due to more people being aware of the program, the outreach that's involved, and people taking advantage of using the benefit that they have. The benefit claims reserve liability is up 8% year over year, which is directionally consistent with the fact that more claims are being filed and utilized. There's 3 main categories of these claims. The first one, the case reserve, those are amounts that are already approved and pending and will be paid in due time. Pending claims have not yet been approved, but are in process of being approved. And incurred but not reporting claims is due to people who are likely to file claims but may have not filed claims yet. As you know, they have 45 days to file claims. So at June 30th, not all of that amount is known. So there's some estimating that needs to be done to determine what's out there. Those last 2 categories are down year over year, which may imply that, again, there's more knowledge to this, that people know to how to file and are more likely to file because of the outreach that's been done, and knowledge from, or education from, employee side to file claims. These amounts are consistent with the prior year. The total benefit claim as a result, the liability in relation to the expense is down slightly. Again, likely due to the fact that more awareness of this program exists. And again, we do primarily analytics on this, as well as some subsequent activity, and look at reports to determine that these amounts are reasonable. And then tactical updates that are coming for you that will be effective. There are 3 in the near future. The 2 that are effective for you this year, the first one is compensated absences. This relates to accrued sick time primarily, but also vacation time for employees that have earned the benefit, and how the recognition of that expense and liability will be recorded on the financial statements. This is a simple standard, or simple standard that's to think about. However, in practice, implementing it may be a little bit difficult. So our plan is, after we get through the audit, meet with Dave and the team and go over the standard in a little bit more detail. There's a couple of different options we can take, and we'll talk to Dave about that. And we're happy to get on another call and maybe discuss this further in the fiscal year about the approach. The second and third one are primarily disclosure related. GASB 102 is about disclosing risks in the MD&A, and GASB 103 is about showing budget to actual. Is one of the main topics in that standard. That would be supplementary information to the financial statements. So from an audit side, the first one will require a little bit of work. The second 2 are the second and third one is more management in the preparation of schedules. Our audit also involved looking at the retirement plans and the other post-employment benefit plans. The majority of that work's done at the state level, where they provide actuary reports, which are publicly available, and the authority obviously records the adjustments required for that. We look at underlying assumptions such as the investment returns and the discount rates, as well as future salary increases. However, a lot of that's determined at the state level, and you're just subject to recording those adjustments. So we make sure that those adjustments are made properly, that the financial statements reconcile to those reports, and the disclosures are adequate as well around that. But no significant changes there, of course, and we didn't come across any errors. The final point I'll just mention as well, we touched on earlier, was the change in application of SPIDA, which is the subscription-based IT arrangements. That was a standard that came out a few years ago and was implemented for the authority last year. In year 1 of a standard, it's always difficult to do an analysis and to determine how to implement things, especially in the GASB world, where there's not a lot of early adopters, or there's not a lot of information from others to look at. So in year 2 of the standard, which just coincidentally happens to be our first year, and we do the deep dive and looking at the model and looking at what was previously done and reported, we agree with management. Management and us agreed that the arrangements did not have to be accounted for under that standard, primarily due to the fact that all the arrangements are really held with the state, and that you're really just benefiting from the state's arrangements. So when we looked at the net impact of changing that application, it was a very immaterial amount and didn't have a significant impact at all. And I think that the financial statements are a little bit easier to read without that information. And I'm sure management would enjoy not preparing those schedules as well. So it seems like it was a good approach to take, and worth taking. So I'll just throw that out there, because that is something that may generate questions, and you may have questions when you heard that. but we're very comfortable with it and don't have any issues with that. Was that the end of our slides, Katrina? I lost track of what else we have. Yeah, so there's our final slide in case there's any questions, of course. And again, I'll echo the fact that everything went very well. You know, I don't very happy with it. Of course, every time you do a new audit, there's a learning curve, but it really wasn't significant. And I'll give credit to Dave and Aaron for that as well for running a good team. And of course, the team was great to work with.
Does anybody have any questions for the auditors this morning? I don't.
There'll be at least one question, right? We need at least one.
Well, it was a clean audit, so that's always a positive thing. I was going to see if any of my colleagues had a question.
All right, I'm good. It was a clean audit. I'm very happy with it. Thank you.
I don't see any, so we're going to let you guys off easy this morning.
Okay.
It seems.
Well, you like to mention too the first slide, and I kind of skipped over it because we did an introduction verbally. Our contact information is on that. I encourage everybody and remind everybody of the responsibility and the obligation that if anything were to come up during the year related to any concerns you have, even if you're not concerned, if not sure if you have a concern, but you want to talk about it, we are available to you. That's our responsibility. So, and like I said, your obligation too, if you're aware of something, to communicate that to us. So, you know, we've had calls with Holly. We've asked specific questions. We can't possibly talk to everybody one-on-one. However, that line is open to everybody for anything that would come up during the year. As auditors, we appreciate that and use that in our audit documentation that we've communicated that to you.
I appreciate that. It's always good to have access and transparency. So thank you very much for your time this morning and your team's time and attention to the business of the authority. And I think we will move on then this morning if there's no questions for our auditors. And we will transition to a budget review of spending to date, which Dave is going to lead us through.
Dave, do you want us to stay on and listen to you? Because I'm happy to, but if you want to kick us off,
it's up to you. You're more than welcome
Okay.
to stay. You're more than welcome to leave. So whatever you want to do is.
I'm gonna stay, but if my team has other things
that's
to do,
fine. I will say thank you for all the work you did on the audit for the authority. I share your in your statement that it went smoothly and we enjoyed working with you and your team, especially because it was first year. So I agree that things did go well. So thank you for that.
Absolutely. Thank you, Tom, Katrina, and Rob. And we appreciate your partnership with us, but we also don't want you to feel like you have to stay around just to be polite.
I want to hear Dave present, so I'm excited to stay.
The pressure, the pressure.
No pressure, John. No pressure. Not from the auditors or the committee. Okay, so let's talk about the month of September. And let me get the statements up.
Can see your screen, Dave.
Thank you for the confirmation, Stephanie. Okay, for the month of September, in terms of our operating account, we had net activity of $1,062,000 negative. That was just under $300,000 better than budget. The expenses for the month continue to be the typical expenses, payroll and related expenses, $679,000. Software licenses were $140,000. That's a little higher than usual, but that includes our annual MuleSoft license, and MuleSoft is a software that helps Salesforce talk to other systems and platforms. So we paid that during the month of September. Also had contact center expense of $128,000 and outreach expense of $87,000. Most of the variances for the month were positive. There was a negative variance of over $24,000 for the software licenses. MuleSoft did come in higher than we have budgeted for. So that's year to date, but we don't expect that to materially expect the positive variance that we have in totality for the first quarter, which is a $1.2 million variance. So our actual results were almost $2.1 million compared to a budget of $856,000. On the revenue side, it was just fund recovery penalties this month, and those came in slightly above at $12,000 for the month. That's what's going on with our operating account. With our bond account, we did spend just under $230,000 for our fund recovery efforts this month. This actually represents 2 months of expenditures. We did catch up in the month of September, so that's why we are over budget for the month by almost $130,000. But year to date, we're just slightly over at $16,000. So we did catch up during the month of September. That leaves us, oh, let's make that a little bigger so you can actually see it. That leaves us with just under $2.1 million of bond funds that are available for the authority to use, and we will be using more of those in the coming months ahead, including for fund recovery purposes. Moving on to our contribution activity. Our contribution activity was a negative $31.9 million. That was $3.7 million less than budget. The main driver of that, again, continues to be benefits paid, which was $4.7 million more than budget. That our actual activity for the month was $33.2 million. That averages out to about $8.3 million a week. That is down from the prior month of about $8.5 million a week. But that's because there was the holiday of Labor Day, and whenever there's a holiday, that week's benefit payments go down. So that we expect that will probably be just a temporary anomaly. As a matter of fact, in the month of October, we did have another record-breaking week of benefit payments, almost $8.8 million. So the benefit payments are still going strong. And like I've said before, we are monitoring this because as you can see, year to date, our benefits are higher than budget by $16 million. And that's the main driver for why the net activity is $10.2 million. Next month, we're going to be working with our actuaries at Spring and prepare a projection for the rest of the year to see how the numbers are going to fall out, because we do expect benefits to be paid, benefits that are being paid will be higher than what we budgeted. Again, because when we budgeted about 6 months ago, our run rate for the benefits was about $7.5 million. And then a few months after that, they went up to 8 and are now at about 8.3 or $8.5 million a week. Spend a second on contributions. Contributions for the month were $559,000. That was $150,000 better than budget. Our fund recovery efforts were also $45,000 better than budget. And our investment income was about $600,000 better than budget, coming in at $2.5 million. I will note that the rate on our investment account, which previously had been 5.4% for quite a few months, did decrease down to about 5%. That's because, as you know, the Feds reduced their rate by about 50 basis points, and that eventually filters down to the STIF account that produces the investment income. Having said that, we are still ahead of budget because we did budget at a lower interest rate than what we're getting, even though the rate did go down from about 5.5 to 5% for the month. Because as you can see, we're still $2.1 million better than budget. What does that all mean for the contribution fund? As I like to say, the contribution fund is at over $572.5 million as of the end of September. So still in a good place. Quick look at the balance sheet on a cash basis. Of course, our total assets are over $592.2 million. The biggest asset, as always, is the STIF account at almost $555 million account, $555 million. Other assets, as usual, continue to be the $17 million in the impressed account that we have at Aflac to pay benefits, fixed assets net of $2.4 million, and some other accounts that we have cash in for our operating reserves and our bond funds. And our main liabilities continue to be the bond funds payable that totaled $12.8 million, and a portion of that will be paid later on this year. So that's what's going on at the authority for the month of September and year to date for the first quarter. I'm happy to take any questions at this time from the committee.
I had one quick question on the debt service, because I know that the authority pays its own debt service for bond issuances. What's the duration of the repayment term again?
10 years.
Okay, that's what I thought. That's what
And
I
we've
thought.
made 2 payments so far, so 8 years to
Okay.
go.
All right. And then I actually had one further question. The spring projection, it's going to bring us through the balance. They'll do a projection for the balance of the fiscal year, and then are we going to do like 3 years out? Are they going to kind of rerun that sensitivity analysis that they do where where if we modify our actuarial projections, this is kind of where we think we'll end up relative to fund balance and burn rate? Okay.
Yes, so we're certainly going to do one at least through the end of this fiscal year, and then based on the latest information, we're going to take it out a few years and just see how it looks going in the future. Because as you remember, the policy for determining the contribution rate, which we do on an annual basis, right now, formulaically, they look at it 10 years going forward. So we'll be looking at that as well and seeing how it affects possible future recommendations for any change in the contribution rate.
And also,
Okay. Oh, sorry, Erin.
sorry, I was just going to say, time is speeding along, and starting in February, we're going to be looking at next year's budget. So that analysis that we're working on with spring will help us with if we need to make any adjustments to this year's fiscal year budget, and will help us for next year's fiscal year budget.
Yeah, I think, my mind's eye was kind of towards those deliverables. And so one of the things that I think spring has done in the past, or perhaps you guys have done it with the assumptions, but is kind of shown like, what the swing is with various percentage changes. So I think if anything material changes with regards to what the actuaries believe are reasonable assumptions for our forward projections, then maybe kind of that graph can be updated, because it's a helpful visual. Okay.
Yeah, absolutely. And we're working with spring, and as we gather more data from other programs as they mature, we're just looking to see how quickly we get to maturity. Clearly, California's experience, where it took them 10 years, is not going to be our experience. We know we're going faster. So we're just trying to
Right.
figure out how fast.
Well, and I'd be interested to see if some of the states that saw, double-digit increases in benefits have started to either stabilize or if we're still seeing substantive growth in those. So I'm interested to see what the next the next phase of modeling shows us. But all right, well, do any of my colleagues have any further questions? Don't see any. All right. So is there any old business this morning? Any new business? All right, well, we can give you all some time back this morning. We won't formally have a motion to adjourn because we don't have quorum, but I'm going to close the meeting at 9:39, and I hope everybody has a wonderful weekend.
Thank you so much. It was
Have a
good to
good
see
weekend,
everyone.
everybody.
Bye,
Thank you.
everyone.
Thank you.
Bye.